Hello guys and welcome back to my YouTube channel. Today we'll focus on production and cost. But before we get there, let's just do a quick recap on what we learned in the previous video on factors of production. So I call these our FOPs, which was factors of production, and we had 5 of them. We had land, labor, capital, entrepreneurship, and technology. What these were, or what these represented, was our inputs. So whenever we combine a certain amount of inputs, we can create an output. I gave you an example of a pizza restaurant. So if you open up a pizza restaurant, what do you need in order to create the perfect pizza? Maybe you need stuff like ingredients, water and electricity to make the pizza, and also something like wages. Where in order to create the perfect pizza, we need to combine the inputs in order to create an output which is for the consumer. So our 5 factors of production were understood to be our inputs, and our output was obviously our pizza. Now that we understand what factors of production are and how it's used to create output, we can understand that the goal of every firm is to make a profit. Now, how do we make a profit? We need to analyze the difference between their costs versus output. And output is normally measured in the form of profit. So we have a certain amount of costs that we try and keep as low as possible in order to create a higher profit or output. And this is now where students struggle, trying to understand concepts like marginal cost, marginal revenue, total revenue, and total cost, but we'll break this down as we go along the video. Okay, so how do we mathematically represent or calculate these types of inputs and outputs? So we know that inputs represent everything that is referred to as costs, and output refers to everything that we try to calculate our profit by. Okay, so a business always has costs. The first cost that we can try and calculate is a total cost. And the total cost is equal to the fixed cost plus a variable cost. We can easily just represent this now as total cost is equal to a fixed cost plus a variable cost. And what a fixed cost is basically stays the same for, let's say, a period of a year. So something like your rent, insurance, and our variable cost varies with the production level. So let's say, for example, we sell 1,000 pizzas this month, but next month we sell 2,000 pizzas. So it varies. We don't know how much we're going to be using in terms of ingredients, but we do know that it's going to vary all the time. It depends on the amount of demand for our product. So let's say, for example, we all of a sudden get a rush of people buying pizzas, then we'll require more electricity as well as more ingredients. So it always fluctuates. So therefore, it's called a variable cost. So fixed cost plus variable cost is equal to our total cost. Then we've got something which is our marginal cost and an average cost. What I will do for these two, or for these concepts of marginal and average, is I'll do a separate video for that so you can understand it. But what I'm going to do is I'm just introducing it to you here so that when we do the next video, then we'll be able to understand it a lot better. So our marginal cost is a equation that looks like this, where it's change in TC over change in quantity. And our average cost is change in, sorry, not change in, it will be total cost divided by our quantity. These two we will focus on in another video, but for now they fall under the cost side because obviously it's called marginal cost and average cost. On the right hand side, we have something called total revenue, which is equal to price of a product times the amount of quantity we sell. So let's say, for example, our price of pizza is 50 Rand and we sell 10 of them. That will give us a total revenue of 500. So how we represent this would be total revenue is equal to P times Q. This is very important to understand. Then we move on to our marginal cost. Our marginal cost for now, we just need to know that it's change in total revenue over the change in quantity, and our average revenue is equal to the change in total revenue over change in quantity. This will be discussed fully in the next video. So marginal cost, marginal revenue, sorry, this is marginal revenue, average revenue, and average cost will be discussed in a separate video so that you can understand the concept of those four in more detail. For now, though, we can still calculate our total profit. So total profit, which is represented by a pi sign that looks like that, is equal to total revenue minus total cost. And here we understand now that to calculate total revenue would be price times quantity, as we listed here. And our total cost is where we have a fixed cost plus a variable cost. And that's described over here, where we have a fixed cost, which is fixed over a period of time, and variable cost is our ingredients or things like wages, because we can hire and fire people in a day, 2 days in a month. So that fluctuates over a year. And also if we look at water and electricity, because we don't know how many pizzas we're going to be selling, therefore the variable cost will always keep varying depending on the demand for our product. So here we have the formula of total profit, which is equal to total revenue minus total cost, and that's basically how we work out our profit level. Okay, so we get different ways of calculating profit. One is at the accounting profit, and the other one is economic profit. There's two different ways to calculate it. When we calculate the accounting profit, we would say profit is equal to total revenue minus the total cost. And this total cost just takes into account the explicit cost. An explicit cost is something like, or costs that are tangible. So you can see them, let's say, for example, the ingredients, tomato base, cheese, water and lights, wages. Those are all tangible in the sense that you can see what they cost and how they're paid for. The way we work out economic profit is slightly different. So here we have economic profit, which is equal to total revenue minus the total cost. But the total cost is equal to the implicit plus an explicit cost. So very similar to the way accountants calculate profit, but in terms of economics, we add something called an implicit cost, which I'll explain to you with an example here. Okay, so let's assume we have LeBron James, the NBA superstar, who earns around $10 million per annum. So that's his scenario number one. Scenario number two is that he would like to stop playing for the NBA and rather open up a pizza restaurant. So he approaches you and he asks you, should I open up the pizza restaurant and quit my playing career as a basketball player? So you now have the second scenario where you open up a pizza restaurant and your explicit cost is $1 million per annum. An explicit cost is something that you can see or touch, like, for example, water and lights, electricity, wages. Those all come up to $1 million per annum. Another way you can also understand it is it's a fixed cost plus your variable cost. And that's what an explicit cost is. Then we have total revenue, which we remember as price times quantity, and that equals to $2 million per annum. So if we have to work it out the accounting profit way, we would say profit is equal to total revenue, which is 2 million. So 2 million minus our total cost, which only takes into account the explicit cost of $1 million. So here we have a profit level every year of $1 million per annum. So it seems like it's a good decision for him to open up a pizza restaurant. But now let's work out how we calculate profit using the economic profit method. So here again, we have our profit, which is equal to our total revenue, which we know is price times quantity, which equal to 2 million, minus. Now we've got a implicit plus an explicit cost. We know on the left-hand side that we have an explicit cost, which is your wages, your fixed cost plus your variable cost is equal to 2 million, or 1 million, sorry. So we've got 1 million. But we have an implicit cost. Now, what is an implicit cost? An implicit cost is something like an opportunity cost. An opportunity cost represents the word opportunity. So let's say, for example, we have a decision that we need to make every single day. Do we study or watch television? Do we go to work or chill at home and not earn any income? That's an opportunity cost. Now, for LeBron, in his example, he's earning $10 million per year playing in the NBA. If he were to open up a restaurant, he'd now have to forego that 10 million in order to receive an income from the pizza restaurant. In this case, the amount that he's losing is 10 million. So he loses 10 million, which in total equals a loss of $9 million. So the only difference between the accounting profit and economic profit, the way you calculate it, is that you take into consideration the implicit cost or the opportunity cost of foregoing or making one decision against another decision. So here we can see that if we were to consult the economic profit method, we would make a loss of 9 million, whereas if we worked out the profit using the accounting method, we would make a profit of 1 million. You can decide which one is better for you, but taking into consideration that he's losing out so much, it would obviously make a little bit more sense to go with the economic profit method. So to summarize, we focused on our FOPs, which is factors of production, using our inputs to create outputs. Then we actually went and delved into our input versus outputs, which took into account our cost versus our revenue or profit. And here we discussed things like our total cost, which is equal to the fixed cost plus the variable cost, and our total revenue, which is equal to our price times quantity. And then we also mentioned our marginal cost, average cost, marginal revenue, and average revenue, which we'll discuss in a later video. They will delve straight into it. And then number 3, we looked at the difference between accounting profit versus economic profit. The next video will delve a lot deeper into the costs versus output and going through things like marginal revenue, marginal cost, average revenue, average cost, dealing with the cost curves, and then moving on to the different market structures, which involve the perfect competition, monopolies, monopolistic competition, and oligopolies. So this was just a brief introduction to costs and production. When we get into the later videos, you'll see how all this ties up together, and we can try and understand that keeping costs as low as possible and becoming efficient leads to a greater output or profit level naturally.